Okay, so the next thing we got to talk about is horizontal analysis. And much like vertical analysis, it does exactly what it says it's doing. You are horizontally analyzing things. What we'll refer to this as is time series analysis. Right here you'll see time series analysis. You will hear me refer to that, refer to horizontal analysis as time series analysis as well. I think both of them are fairly descriptive of what we are doing. Horizontal analysis, it's descriptive because we are looking horizontally at things. Time series analysis because we are looking at things over time. We are looking at trends in financial statements over time. For a single company, this is not a comparison from company to company like what we could do with what we saw with the vertical analysis earlier. This is a single company looking back year to year to year. Okay. Typically, like I said, remember when you do a trend, when you look at a trend, you want to look at 3 years. However, with horizontal analysis, what we're doing is we're looking at probably the previous year, and we're going to get a change in percentage. How much did this increase or decrease? What was that percentage increase or decrease? Okay. So some questions you can start out with, and these, like I said, they're very general, high-level overviews. We got another instructor in the hallway that likes to call this kind of your 30,000 foot view, right? You're looking down from 30,000 feet at this, and you're slowly going to circle down, and get closer and closer. These are your 30,000 foot questions, okay? So are sales growing faster than cost of goods sold? If so, why? What was the percentage, right? We're comparing to last year. Are sales from last year growing faster this year, right? Are they growing faster than cost of goods sold? Are operating expenses growing faster than sales? If so, why? What can we do to reduce that? This is where you would drill down and you would say, okay, which operating expenses are growing faster? Which ones are causing, which of these are our cost driver, right? Which ones of these are driving our costs up? How can we more efficiently handle those costs? Are specific expenses increasing at a higher rate than others? Okay. This would help us again drill down and go, okay, which expenses and why? What can we do about it? Let's say maybe we've got a specific product that we buy from a specific vendor, and we've been buying from that vendor for 15 years, and really we haven't changed vendors simply because it's easier for us to not change vendors. But we could go with this other vendor and save 5%. Now that's that 5% reduction in cost of goods sold. Does that equate to a 5% increase in net income? Maybe. We would have to look into it. We would have to do some calculations. There are other costs to consider, right? But that's why it's good to ask these high-level questions. This formula right here is going to be important for you to know. This is how you calculate your percentage increase or decrease. So you may see questions on your homework, on quizzes, on exams that ask you, what was the percent change in net sales from 2019 to 2020, okay? So you always take your current year amount, you subtract your prior year amount, that gives you your change, and then you divide that by your prior year amount, and that's going to give you your percent increase or decrease. If it's a negative number, it's going to be a decrease. If it's a positive number, it will be an increase, okay? This is your balance sheet. This would be horizontal analysis of a balance sheet. So same concept. We're going to find, what was our percentage increase or decrease in current assets here? Well, we're going to take this year minus last year, right? That gives us a positive 354. We'll divide that 354 by 4673, and that gives us a percent increase of 7.6, okay? So we will move on to ratio analysis. Okay, those two things, vertical and horizontal analysis, conceptually, you've got to understand. You've got to be able to perform those things as well. So horizontal analysis, vertical analysis, you're going to have to understand it conceptually, be able to answer questions about it conceptually. You're going to have to be able to answer questions about it from a computational perspective as well. Okay, so let's talk about ratio analysis here real quickly. And this is something we've done throughout the entire semester. We have talked about a lot of different ratios. The ratios that we've talked about help managers. They help third parties make better decisions about investing, about lending. What we're going to do in this chapter is really kind of bring those ratios together so we can take a comprehensive look at our financial statements, ask some questions, okay? but we need to categorize those into 4 different groups. And once we do that, we'll be able to talk about different attributes of the company from a financial perspective. So the first group is our return to shareholders ratios. Okay? And this basically just measures the company's ability to generate returns to their owners. So these are your equity ratios, return on equity, right? Return on assets, that kind of thing. We've done those in previous chapters. It's really just what are we giving back to, not in a dividends sense, but what are we giving back? What are we generating to give back to our shareholders? The next one is profitability, and this is it measures the company's ability to generate profits from sales in particular, as well as measuring other operating effectiveness. So other aspects of operations, how effective are we at generating sales from assets? How effective are we generating sales from inventory? That kind of thing. The third one is asset management, and this lets us know how well are we able to use assets to generate sales. And we also look at measuring other types of operations as well. And then finally, credit risk management. This one is primarily for lenders, but investors want to know this one as well, simply because it tells us what is your risk of going bankrupt. Is there a risk in investing with you, right? If there's a higher risk in investing with you, there better be a better reward, right? So when we measure short-term obligations, the ability to meet those short-term obligations, we refer to that as liquidity. How quickly can this turn into cash and pay off those obligations? And then when we measure the ability to meet long-term obligations, we refer to that as solvency. Are you going to be a going concern? Can you meet your long-term debts? Okay. This little graphic here just kind of shows you the 4 categories that we talked to, and then you'll see here in the middle we've got a 5th category, and that 5th category is valuation. And there are a couple of ratios that we use here. This is your earnings per share. This is your times interest earned, that kind of thing. Your earnings ratios. Okay, so the next few slides I'm not going to spend a lot of time on because these are in your notes. I put these in your notes for a reason. These are all of the ratios that you're going to need to know for your exam. Okay, what this is going to do is it tells you what category the ratio falls under, okay, and then what chapter it is, as well as the calculation for that ratio. Okay, this will be extremely helpful for you when you are studying. So I'm not going to spend a lot of time on these. We're going to kind of fly through these next few slides, and then what we'll get to next is actual analysis using these ratios. Okay. All right, so let's start with return on equity. This is the first ratio we're going to talk about. Okay. What return on equity does is it measures the income earned for each dollar that you have in stockholders' equity. Okay. What we're doing is we're relating net income to the investments made by the owners of the business. What you end up getting is a percentage here. Here we can see that VF, remember this is North Face, has a 16.4% return on equity. What this means is that for every dollar that somebody invests in us, for every dollar in equity that we have, we're going to return to them 16.4 cents. Okay. So for every dollar that somebody invests in us, they can kind of expect a 16.4 cent return, right? So what this does is we can look at it and we can go, oh, okay, this is a fairly safe investment for us. We're going to see a return. Okay. Return on assets is very similar, except now instead of every dollar of equity, we're looking at every dollar that we as the company invest in our assets. Now, notice one thing I do want to bring up again, just conceptually for you guys. Notice that we are using average stockholders' equity, right? Why is that? Why do we use that average number in the denominator? Well, again, it's because up here in the numerator, we've got an income statement account. Income statement accounts are for a period of time. They look at the entire the entire year, right? Let's say we're reporting on an entire year. The income statement's looking at that entire year. The balance sheet's only looking at that exact second that we ran that report. Okay, so in order for it to make it look like, or to make it feel like we're using an entire year's worth of stockholders' equity, we use the average, that beginning plus the ending divided by 2. Okay, so it's because we are dividing an income statement account by a balance sheet account that we use the average. Okay, so back to return on assets, like we were talking about. Return on assets, very similar to the return on equity, except now we're looking from the company's perspective on how much are we investing in assets. For every dollar that I invest in an asset, what do I get in a return as net income? Okay, now remember, net income is less any of our expenses, right? So we're not looking at sales here, we're looking at net income. So here we can see we get a return of 5.9%, meaning that every dollar that I invest in assets, I'm going to get a return of 5.9 cents in income. Okay. Well, what if Nike's got a return on assets of 9.2? What could that tell us about the difference between these two companies? It might just tell us, just from a very general, quick look, that Nike might be better at leveraging their assets to generate income. Okay. I say might, they definitely are. But what that might lead to is questions about, well, what kind of assets does Nike hold versus the kind of assets that VF is holding? Well, then we could go look at the 10Ks and we could look at their list of assets, particularly their PP&E, those long-term assets, right? We can look at those and we can see, okay, these are the kind of assets that Nike's holding. Maybe they've got a lot more resources to use. Maybe they've got more resources to leverage. It makes it easier for them to more efficiently manage their resources to generate income. You would also want to look at the notes and disclosures and see, how are they accounting for these assets? How are they depreciating these assets? Nike may be depreciating at a slower rate. They may have higher useful lives, which would give them a higher, or they may be depreciating these at a quicker rate. They may have shorter useful lives, which would give them a larger number there in the, or a smaller number there in the denominator, which would give them a higher ratio, right? So there are lots of different things that you could look at. You could start asking yourselves questions about these kinds of things. So this will be the end of this video, but when we come back, we'll continue looking at some more of these ratios and asking some more questions, getting a little deeper into it.